So let's talk about policy charges. What really causes that cost of insurance to be so high? I'm going to be very specific with this and break down everything for you. Most agents do not show policy charges. They don't show policy charges because it can make you not want the policy to begin with. So let's break down target premium first. So this individual is 31 years old. He's paying $6,000 a year into this policy. Now, I don't want you to really focus on this right here because these are basically breakdowns. This part right here is the sum of all the ones to the left. So you want to look at this as a focal point, the policy charges right here. For the first year, he's paid $6,000 into this policy, and the policy charges with this target premium policy is $2,168. Now, in terms of the growth that he got that first year, it's going to be the interest credit. He got $300 in growth that first year, no dividend bonus from the insurance company on that first year. So his total credit that he got that first year is $300. The accumulated value is the amount he paid into a policy minus the policy charges plus the interest. So the accumulated value in this case is $4,132. This is the amount that he's getting interest on every single year. His first year is about $4,000. Now, surrender charge, it's $12,000. And the cash surrender value is the amount he has access to take out as a loan at any given year. For the first year, he has access to $0 to take out as a loan. But the net death benefit is $7,835. Now, look at the second year. The second year, the policy charges increase, 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 increase. They're going to keep increasing. But so is the total credits. In this case, it's not becoming a match, and the total credit is not surpassing the policy charges. He doesn't have access to his money until the third year, and he has access to more money the fourth year. So he has to wait basically 3 years to take out any loans from his policy. A greater comparison would be this amount right here. So this is the total of the last 5 years. He put in $30,000 into the account. He's been charged $11,000 policy charges, and he got $4,300 in terms of interest in his account. Let's scroll down a couple years to where it started lapsing, and I'm going to highlight that. So for a limited period of time, the growth in the account actually surpassed the policy charge. For example, let's look at when he's 60 years old, $7,854. And his total growth that 1 year is $11,211. So it did pass, but it starts shifting bad for him when he's 72 years old. The policy charge is $12,201. And his total credit in terms of growth in his account is $11,000 still. The policy charges are going to keep increasing every year, but his growth is not keeping up in the policy. So the charges are eating up the policy, and this is the big negative of a target premium policy. The cost of insurance does increase typically with IULs, and that's why people talk bad about it. And this is really a key point of why when it's target premium policy, the policy charges and the cost of insurance will eat up the policy. Here's the column for cost of insurance. Every year it keeps increasing. And then 75 is 17,000, and then it's 19,000 the following year. So it keeps increasing and increasing, and there's a drop for his accumulated values. So now the amount he's getting interest on has actually been plummeting every year until the point where he's not going to have any amount in there that he can't get interest on. At year 83, the accumulated value is zero. So he doesn't have any value whatsoever in this account. The surrender value is zero as well. So he lost every dime that he ever put in this account if he never took out a loan. Now switch gears to the max funded policy and break that down. So this max funded policy has the same premium amount, which is $500 a month. There's some key differences though when we look at the actual cost of insurance and policy charges. So year one, he put $6,000 into the account. The sum of the policy charges for that 1 year is $891. He's getting the total growth of $344 in that first year. His accumulated value, the amount he's getting interest on, is just under $600 less than the premium. So it's $5,453 for the accumulated value. Again, the amount that he's getting interest on. And then the cash surrender value is the amount he has access to as a loan. Year one, he has access to money in this account. That's 47% or so of the money he's actually paid into the policy he has access to in year one. So $2,802. In year two, the amount goes up. And every year it keeps getting closer and closer to the accumulated value to match up. So you get access to the full amount that you're getting interest on in year 11. And for the surrender charge, there's no more surrender charge after the 10-year surrender period. So it's zero for that charge afterwards, which means he has access to the full amount that he's getting the interest on. Now, let's highlight something very, very important, something cool as well. In year 3, the policy pays for itself with the growth in the policy. So he's paying $923 in terms of policy charge in year 2. He's getting a total interest of $693. Year 3, he's paying $954 as a policy charge, and his interest is $1,062. His growth in the account has surpassed his policy charges. Yes, policy charges will keep increasing for the life of the policy, but it doesn't matter if the growth is going to outpace the policy charge. The next year, its policy charge is $983. The interest is $1,453. And this is with 6.42% interest. This is not the 15% interest or nothing like that. Now, a summation of the last 5 years, it's paid $30,000 to the account. Policy charge is $4,761, and his total interest credit for those 5 years is $5,420. The policy is paying for itself. Let's look at 15 years after you open up the policy. It's paid $60,000 into the account. His total policy charge is $13,220, and his growth that he's had over that 15-year period is $51,000. So the policy is going to be paying for itself. This is why it's max funded. You're maximizing your cash value accumulation because you're lowering the cost of insurance. Now, every year, you're going to be having more money going towards the accumulation. Now, let's scroll down to 120 years old so we can see the total growth that he's had. So now he's 120 years old. He's only paid $60,000 into the policy, which is $6,000 over 10 years. He doesn't have to pay anymore. If he wanted to keep paying into the policy, he could have, but he didn't have to. And then the policy charges for his entire life has been a little over $2 million. But his growth that he's had in the account has been $7.6 million. It's a huge gap on that. And the difference between that essentially is the accumulated value, which is 5.7 million. And he'll have access to take out 5.7 million during that time. And whenever he passes away, let's say he passes away at 120 years old, the family would be getting $5.8 million completely tax-free. This is the beauty of max funded policies. Whether you go with me or not, I want you to be aware of this for any insurance agent. Always request the policy charges and have them walk you through that so you know what's going on, or at least have an eye on what's going on yourself, because you want to make sure this policy is sustainable for the rest of your life. Now, if you have any questions, feel free to comment or DM me, or we can book a call on my calendar and have a strategy session on what can work best for you. But this is a matter of education for you and for other people that is watching this video to make sure they're not being blindsided when they're looking to get a policy. And at the end of the day, it's a long-term commitment. This is something that you should have for the rest of your life. So you should want to make sure you're getting set up properly the right way initially.